Is Shift still a stock to buy even with the merger and reduced revenues? Well, in this video, I'm going to share what these things could mean for the company and whether or not I'm buying, selling, or holding. Now, I just talked about this company a couple of weeks ago, but I think now that the earnings season is over, we can actually look a little bit more clearly into what changes are going to be made and whether or not this is good for the company or not. But I don't want to waste your time, so let's go ahead and dive right in. Okay, so looking at price action, Shift hit an all-time low of 60 cents back on June 16th. And for about a month and a half, the stock went on an absolute tear, reaching a high of about $1.50. So why did the company have its stock price cut in half? And what does this mean for shareholders? Well, to answer that, I think we need to look at what is happening with the merger between Shift and Carlotz and the steps that are needed for both companies to succeed on their desired goals. On August 9th, which is when Shift's earnings report came out, the team announced that they are merging with Carlotz. So I think the first question people were asking is why merge with another company who had a small market cap and a relatively similar business? If we look at both of these companies, they had one thing in common. They lacked profitability. But the way that they're getting to profitability is completely different. Carlotz, which is a leading used vehicle consignment business, has their presence in the Mid-Atlantic region. Shift, however, is more focused on the technology side of things, and their presence is in the West Coast. So when we look at their operations, it appears that the merger will be synergistic, because while Shift runs a service that includes the purchase, maintenance, and selling of those vehicles along with their online platform, Carlotz's business model is more focused on connecting sellers to the retail buyers. And when you consider the operational synergy between these companies, it makes this combined company extremely dangerous in my opinion for the used car sector. Not only does the combined company get both business segments, but they also get to use these business segments in new locations. Shift has always wanted to expand to the East Coast because there is a huge market there. But the biggest issue was the amount of operational expenses needed to run a hub on the other side of their headquarters. Carlotz will also have the ability to use their business model on the West Coast, but that's not the only thing that benefits both of these companies. What we need to remember is that the used car e-commerce sector has razor thin margins, so it's difficult for companies to get to profitability. Before the merger, Shift was expected to be profitable in 2024 or 2025, and they simply did not have the cash to get themselves to that profitability. So not only did both companies need the cash to get them to the point of becoming profitable, but as we have seen with companies like Carvana and Vroom, cost reductions are key when we talk about gross profits per unit, which is one of the most important metrics in this entire sector when it comes to evaluating how a company is doing with profitability. For Carlotz, they will have massive cost reductions because of Shift's online technology. And this means you won't need as many people on your staff to value vehicles. Now for Shift, they have a great product with their online technology that they have already stated will be their main source for generating sales for the rest of the year. But they really needed an increase in their inventory. And that is something that Carlotz can bring them because of their connections with corporate vehicle suppliers and their current physical locations. But I think one thing that makes many investors relieved is the business plan is expected to be fully funded to profitability from the cash position of both companies. And this is the reason why I think that they are reducing the amount of vehicles that they are selling. Because they are a cash losing company, they want to reduce the amount of cars sold so that they can preserve more cash, so that when this deal does go through, they will have the finances to fund them through profitability. Now, in terms of when each business will become profitable, here are the most recent statements. Shift is really focusing on their online presence, and because of their operational changes, they will be reducing the workforce across their entire business. They are reducing 60% of their corporate position and frontline roles, which will significantly reduce overhead costs. And even though I do feel bad for those who are losing jobs, because I know that must be hard for them, when we look at the business now for Shift, they are in a much better position overall to get to profitability. With their shift to the online presence, even though they will reduce revenues, they will also reduce expenses, which will give them more cash when it comes time for the merger. But with this new business model, the company is projecting positive unit economics in 2023 and company-wide profitability in 2024. And the best part about this is that they are not anticipating to need additional capital for break even, which is significant because that has always been a stress for Shift shareholders. Carlotz, on the other hand, are expected to be break even in 2023. So the first question I had about this is why would Carlotz want to merge if they had the potential to break even sooner than Shift? And it all comes down to competition. Their CEO, I believe, said it best. What became clear is that from a technology and product perspective, we were really behind some of our competition. This tells me two things. The first being that Carlotz recognized even if they could achieve profitability in the next year or two, they would not be able to keep up because they did not have a strong enough product. Their physical locations worked well, but their online product just wasn't good enough. And if we look at where our world is headed, it is going to be away from physical locations into the online world. But the second thing that I think is really important to understand is that what the CEO says goes to show that he really wants this merger to go through. You do not go ahead and have this kind of humility, and I say that in a respectful way, to where you are saying the company you are merging with has the better product. And so the question then becomes, does Shift feel the same way? I think that they do, and here's why. First, the company is making a lot of management team moves. As of September 1st, the new CEO is Jeff Carlotz, and honestly, I think this is hands down the best move for the company. When it comes to Carlotz's expertise in leading the team for Walmart.com, I think him at the helm puts the company in the best position not only to succeed on revenues, but generate solid profits as well. And he is going to be the CEO over the combined company too. Second, the types of moves that they are making right now points to the fact that they need cash for the merger. They are cutting their revenues drastically by switching to their online platform, and that will actually reduce cash burn significantly so they can have the money needed for the merger. But Carlotz would not have wanted to take this role and make these changes if he didn't expect to merge with a soon-to-be profitable business from Carlotz. So how will this combined company get closer to profitability? It is based on four main things. First, they are focusing on lower volumes and shifting to more online. With Carlotz already close to being profitable, plus Shift's online checkout, they won't need as many transactions to achieve the profitability that they have been looking for. Second, they are placing their attention on high margin units. Rather than needing to sell a bunch of cars to achieve profitability, they can focus on cars that will give them the best return, which will improve their gross profits per unit. How they do this is by switching more to value vehicles over core cars. Value vehicles are those 8 years and older or have 80,000 miles. The third way to help achieve profitability is through automating much of their operations. For now, the temporary elimination of in-person test drives and focus on the online checkout channel could reduce about 40% selling costs per unit, once again driving margins up. The last way is through reducing their marketing expenses, and as I said already, reducing corporate headcount to reduce overhead costs. Both of these are going to put the company in a position where they can reduce cash burn while still being able to grow their customer base. So even though their guidance for the rest of the year is not good, I think that the preservation of cash is most important if the combined company wants to stay on their new projections toward profitability. Now, there are some things that need to happen in order for this merger to go through. The first thing is that both Carlotz and Shift shareholders need to approve the merger. According to Carlotz, the board, which have directors for two large institutional shareholders, already unanimously approved the merger, while the other institutional shareholders like Vanguard will more than likely approve the deal as well. For Shift, management has also approved the merger, but we are awaiting Lithia Motors, who owns about 16% of the company. However, they are likely going to vote for the merger considering that they have been partners for a while and have helped Shift in several ways, like obtaining the floor plan financing. But I think the biggest reason for Shift shareholders to approve is because of Carlotz's cash position. And speaking of cash, here is what is required for the companies in terms of cash in order for the merger to close in 2022. Shift will need approximately $10.5 million, and Carlotz will need $58 million. Now, some believe that because of the amount of cash burn, they will need to raise equity. Based on the moves that they are making with doing online purchases, shutting down their Texas hubs, and the amount of jobs that they are cutting, I don't think that they will need to. Also, the team at Shift expects to have a combined cash position of about $125 million upon closing, which will enable them to fully fund their updated business plan. And they believe that there will not be a need for additional capital to reach break even. Now let's talk about how the shares from Carlotz are going to change when the merger happens. As of now, under the current terms, Carlotz shareholders are expected to receive almost 0.7 shares of Shift common stock for each share of Carlotz. But please note that the actual exchange ratio will adjust at closing based on Shift's outstanding shares relative to Carlotz's fully diluted shares. When the closing of the merger occurs, Shift will own approximately 52.9% of the combined company, and Carlotz will own approximately 47.1% of the combined company. As of right now, the transaction is expected to close in Q4, and if I had to take a guess, I'm assuming late Q4 because Shift even says that Carlotz will not have an effect on the second half numbers. The board will consist of 5 Shift members, 3 Carlotz members, 1 mutually agreed, and then the CEO, Jeff Carlotz. So those are the logistics of the merger itself. But this is something that I have to say. This merger has not officially gone through yet, so please consider that before buying the stock. If we see a delay in the merger, we need to ask the question whether or not these companies can last when we look at their cash burn. We have seen companies over the past few years enter a merger with another company that fell through. And even though there are plenty of signs that point to the merger going through, I remain cautious with my position in this company. I recognize that this continues to be a risky play, and that is a major reason why it is one of my smallest positions in my portfolio. There is still a possibility that this company could go under, and I think that is something that everyone needs to consider before buying or adding shares to this company. So please know your risk tolerance before investing. In terms of buying, I'm only adding a few shares as long as it remains under $1. But I need to say that this is one of my smallest adds because of the risk that I mentioned previously. I still want to continue to have this one as a small position, so I'm adding much more aggressively to my other companies. But I hope y'all enjoyed this video, and if you did, smash that like button down below. That helps this channel in a massive way. Also, I would love to know your thoughts and opinions on the merger, so feel free to mention them in the comments down below. And if you're new here, hit that subscribe button and notification bell. That way you're notified when new content comes out. Hope y'all enjoyed the rest of your week, and I'll see you in the next one.